The SEC chairman wants to make IPOs great again. I agree. We'll look at the government's ideas to increase IPO volume, and I'll share some of my own. In IPO Radar news, the government shutdown is ending soon. What does it mean for IPOs? Kim Kardashian's Skims has raised a fresh round, and fitness hardware company Whoop is considering an IPO. Welcome to the show. And it's long overdue that the government tries to make IPOs great again. The number of companies that are trading publicly on U.S. stock market exchanges has been cut in half. It peaked in 1996 at 8,090 public companies, and as of the end of 2024, there were 4,010 companies available for public investment. Now, there's a lot of factors playing into why that's happened. One is that acquisitions have increased over time, and it's easier to be acquired than it is for a new company to go public. And also, the venture capital world has just matured, and there's a lot of money in venture capital. And so when you're a private company and you're growing and people want to invest in you, you may get a venture capitalist knocking on your door saying, hey, we want to give you money. And that's going to be a lot easier to do than getting your company in order to go public and dealing with all of the headaches that come with going public. But when it comes down to it, an IPO and public listing is the mechanism in place for giving retail investors access to the great companies of this country and companies around the world. But IPOs are happening at a later stage in a company's growth cycle. So a lot of the growth is happening before these companies IPO, and most retail investors, ordinary, everyday you and me investors, don't get to participate in those very high growth phases of a company's life cycle. The trend of companies staying private longer really comes down to incentives. If you're a private company, there's a higher incentive to stay private than there is to go public. But one government official apparently has taken notice of this and maybe is willing to do something about it. He's certainly willing to start talking about it. And that is the SEC Chairman Paul Atkins. So shout out to newsletter subscriber Jim F., who pointed this out to me in a New York Times article. But this traces back to a keynote address that the SEC Chairman Paul Atkins gave on October 9th in Newark, Delaware. And he said to the audience, let's face it, in many quarters and for many reasons, taking a company public is no longer so cool as it once was. There are approximately 4,700 exchange-listed traded companies today compared to a high point in 1997. My goal is to reverse the trend to make IPOs great again. That involves three pillars. First, we must simplify and scale the SEC's disclosure requirements to reduce the cost of preparing SEC filings and at the same time make them more comprehensible. Second, we must depoliticize shareholder meetings and return their focus to voting on director elections and significant corporate matters. And finally, we must reform the litigation landscape for securities lawsuits to eliminate frivolous complaints while maintaining an avenue for shareholders to continue to bring meritorious claims. The New York Times and other outlets highlighted some of these comments a few weeks later, and that's where I learned about it, from this New York Times article called Can Paul Atkins Make IPOs Great Again? This came out on November 1st, and it talks about first how it's cool to stay private, how startups are staying private. It mentions a company called Surge AI, about $1 billion in revenue, but is definitely not considering an IPO offering right now. And this is the take we've seen from a lot of private companies. They're focused on growth instead of an IPO, which makes sense. If you're building a company, you don't want to be distracted by compliance and filing for an IPO, because then you have to deal with quarterly reporting and other compliance issues. So that makes sense. But when you stay private, then you're not giving ordinary investors the chance to invest in your company. And the public markets are more liquid and better access to a wider range of capital than the venture capital markets. Of course, the venture capital markets have a lot of money and they're willing to invest in these companies. And so if you're a private company and you're growing, you have venture capital investors knocking on your door saying, hey, we want to invest. And if it's not the top tier, then it's the second tier of companies or the third tier of venture capitalists who want to invest. And I've recently reported on quite a few stories or companies that have said, hey, we don't need this money, but the venture capital firms came to us and said, hey, we want to invest. And it was just easy to get a couple $100 million onto your balance sheet. And so this is a trend, companies just taking investment money when they don't necessarily need it. So looking at these three items that Paul Atkins mentioned, the first is this cut down on required reporting and disclosures. And I think we can all agree that the S-1 filing, which is necessary for these companies to go public, are too long. and they're too complicated, and we don't need all the information that's in them. The last time I was looking at an S1, I tried to see how many pages were in it, and I couldn't even figure it out because there's like 1 through 200 and something, and then there's section F and section A appendices in there. So it's hard to even know how many pages are in them. What we need is a succinct storyline of what's going on with this company. Certainly audited financials is important, and maybe some risk disclosures, but we don't need 400 pages of SEC filings to know if we want to invest in a company, and really no investor, professional or non, needs all that information. So if the SEC can look at a way to reduce the filing requirements while protecting investor interests and maintaining transparency and really focusing on the things that investors need to know and disclosing that and making that publicly available when they file, everybody wins. We've learned that these companies are already using AI to write 90 to 95% of these filing documents. So it's sort of ridiculous that you're just bringing in AI to write these documents. Maybe some accountants come in and look at the numbers, but they file these documents and then they get feedback from the SEC, and there's a lot of back and forth to get these filings in order. Maybe this takes a task force at the SEC that figures out how to streamline this process, make it lower cost, make it so that the auditing costs come down and that the sheer volume of information is reduced. Then how does the SEC process these filings faster to get them out the door? Everybody wins, and it seems like a no-brainer. Hasn't happened yet, but it's really good to see the SEC Chairman Paul Atkins mentioning this as one of the key drivers in increasing IPO volume. Now, the cost and the burden gets a lot of attention, but I was reviewing some white papers on this topic, and there was a study by some people at the Columbia Business School that pretty much said that, hey, this is not so much a cost and a burden thing that's preventing companies from going public. So that's an easy talking point. Hey, there's too much regulation. There's too much of a burden to do this, and so companies aren't doing it. This article out of the Columbia Business School, this study was called Fewer Companies Are Going Public. Are Regulations Driving the Drop? And the conclusion is that no, the burden and the cost makes up a small portion of the reason why these companies aren't going public. If not regulation, what's causing fewer companies to go public? And the answer is the rise of private funding. Venture capital, private equity, and other alternative financing gives companies the ability to stay private longer. Remember, one of the main reasons for a company to IPO is because the employees are saying, hey, we want to liquidate our shares. But now companies are just using tender offers to make that happen. Stripe is doing that. SpaceX pioneered that space, so it's very easy to liquidate your shares if you are a SpaceX employee who has shares. Now that these tender offers are pretty widespread, the whole reason of an IPO for employee liquidity, that's pretty much gone away. So while the burden and the cost is a piece of this, and maybe just the headache of it, if you're a CEO of a startup, you don't want to become the CEO of a public company. They're just two very different jobs. You may not want to take that extra step because you don't want to deal with that quarterly reporting. The president and the SEC has talked about reducing quarterly reporting to only twice a year, and that may help somewhat, but I don't think that quarterly reporting is the reason why a company like Databricks is not going public. They're already doing the things they need to do to become public. They've said they're IPO ready. But we can definitely agree that reducing the burden would help. It would lower costs. The government needs to be streamlined. And so the SEC should look at that issue. The second two items that Paul Atkins mentions in the speech are the ones that he focused on more. And I actually think these are less relevant to why companies are not IPOing. The second proposal that Chairman Atkins said in his speech is about limiting shareholder proposals. Public companies have annual shareholder meetings, and if you're a shareholder, you may propose something that these companies need to vote on. And I don't even think there's a very high threshold for being a shareholder to bring forth a proposal. You could own 100 shares of an oil company and say, hey, we want to vote on an environmental study for a particular oil field or something they're doing offshore. And he specifically calls out the environmental or social issues, like the example I just gave you. I don't think these are a huge burden on these companies. I think they complain louder than they need to, especially if you're a Chevron and you have to do an environmental study on something. That's not a huge deal. Yeah, there's a cost, and yeah, there's an additional cost to the annual shareholders event to encourage shareholders to vote against them. There could be a higher threshold for that kind of thing, and I don't know what the rule is in terms of how many shares you need to own to propose a shareholder proposal. But if you're a shareholder, you do need a mechanism to speak up. And so I don't see a problem with these. There might be a way to reduce them, but they still need to be there. But I certainly don't think that a company like Stripe is not going public because of ESG shareholder proposals. That is just not an issue for these private companies moving forward. So he throws it in here. I think it's sort of red meat for constituents, but I don't think it's preventing companies from going public. The last one is just take aim at shareholders' lawsuits and litigation reform to eliminate frivolous complaints while maintaining an avenue for shareholders to continue to bring meritorious claims. I think there's probably some merit to this idea, is that there's too much litigation. The issue here is I think they want to get some of the stuff out of the courtroom and into arbitration so there's not public scandals for some of these companies. And of course, the legal framework is important for our country and for confidence in our marketplaces, but I don't think this is another reason why these startups aren't going public. It really comes back to these incentives, and when there's money readily available, why bother going public when you're just going to be more scrutinized in the public markets? Those are the three reasons that Paul Atkins brings up. I'd like to add a few of my own because I think there are bigger issues going on here that would address the capability of some smaller companies to go public earlier. If you think back to 2020 and 2021, there were a ton of IPOs. And the reason for those IPOs was that the public market was paying up for them. So if you're a private company worth $5 billion and you IPO'd, you might be worth $8 billion. So there was this opportunity where the incentive was to go public. This led to a huge problem because retail investors, institutional investors too, ended up overpaying for these companies. And within a year, by 2022, a lot of the valuations of these companies that went public fell dramatically. And we saw it with Robinhood and other fintechs. We saw it with Rivian, certainly, and the stock price plummeted 80, 90%. So there were several cases where a company either SPAC'd or IPO'd and the public markets overpaid. The public markets have gotten wiser from that experience. And so some of these venture-backed companies are not going public because they may be worth more in the private markets, where venture capital has a lot of money to burn. So it may take some private market losses to encourage some of these companies to go public, or if the public markets become euphoric again, there might be an opportunity for these companies to IPO again, for better or for worse. If you're a retail investor, you don't want to be overpaying for these IPOs or chasing IPOs into the public markets when the prices get out of control. Another reason I've learned that companies don't go public, and this is especially the smaller companies to mid-sized companies, there are a lot of auditing requirements that go into these SEC filings. And apparently there's a bottleneck for auditors. There are not a lot of auditors that want to do this work for smaller companies. They'll do it for the bigger companies. You have to have the big four. They'll happily audit any billion-dollar plus IPO. But if you're a $100 million company and you want to IPO, there aren't a lot of auditing firms that are willing to do that work. I think first because of the cost. I also think there's some potential litigation risk for those auditors. I saw Commissioner Hester Peirce of the SEC talk about this. I was at a conference and someone asked a question about this particular issue, and she said, absolutely, yes, it's an issue. So there's a shrinking audit firm pool. The costs are high for a small company to go through this audit, and there's compliance and liability risk for these auditors that prevent them or scare them from going into this business line. This is an issue for smaller IPOs, including small to mid-size and Reg A plus IPOs. One of the solutions here, and this kind of goes back to the first item on Atkins's list, is to scale the amount of compliance and requirements with the size of the company. So if you're a $100 billion company, you may have the maximum amount of compliance and regulatory filings you need to file. But if you're a 500 million or below, there might be a different level. If you're 100 million below, there may be fewer requirements and compliance issues. And this all comes back to cost and headache and burden and all that. All this can be done while maintaining confidence in the markets and transparency. But if OpenAI were going to go public at 500 billion, there should be different standards and regulations than for a company that maybe has 100 million in revenue and wants to go public. In 2012, the Jobs Act was designed so that smaller companies would have an avenue to IPO with fewer requirements. There's some issues with the size of the amount of money that companies can raise. So there are lobbying efforts and organizations working on that problem, and the SEC is open to listening. So we do expect some changes there during this administration's tenure. Two other ideas that may not be as popular for incentivizing companies to move into the public markets instead of staying private. And the first one comes down to this rule about the number of investors who can be on your cap table. So Section 12G of the Securities Exchange Act, which requires private companies to register with the SEC to begin their public reporting once it exceeds 2,000 shareholders or 500 non-accredited investors and has over 10 million in assets. And so this whole requirement, 2,000 shareholders, is why SPVs, special purpose vehicles, have proliferated. You could be an investment fund that creates an SPV with 100 members in it, and then that investment fund goes on the cap table and it counts as one toward that 2,000 investor threshold. What's happening, though, is that there's this web of SPVs and sub-SPVs that are required to get onto the cap table of certain companies like SpaceX, like OpenAI, because 2,000 investors is just not enough to be a $500 billion company. We saw Elon Musk talk about this in a recent event. I think it was November 6th. He was on stage, and he has changed his tune a little bit about SpaceX possibly becoming a public company because he wants Tesla investors to have the opportunity to invest in the future of SpaceX. And he mentioned this rule of 2,000 investors on the cap table, which is preventing them from having that opportunity. So he sort of said in passing, well, maybe we should take SpaceX public after all, which would be an extraordinary event if that were to happen. He's maybe starting to think that the positives are outweighing the negatives. And certainly if he wants his Tesla investors to be able to invest, he's going to need to take the company public. Tightening these rules and requiring more transparency to this whole web of SPVs and this cap table, or some sort of modification to the existing laws, I think would help more companies IPO, because if you start hitting that threshold and you need to go public, then you need to go public. That was the intent of the rule. The SPVs, which are just LLCs, separate entities, creating SPVs and putting them on the cap table versus the 2,000 shareholders or 500 non-accredited, it's just sidestepping the SEC law. That law could be modified or changed or made more strict to encourage more companies to IPO. Of course, the venture capital world doesn't want that. So it's a very strong lobbying group with lots of money and lots of connections. So I don't expect that to happen. If anything, I think they might loosen that rule to make private investing more accessible to more people, in which I'm also for. If you go back to episode 1, I talk about more access for retail investors, non-accredited investors, to invest in pre-IPO companies. And the SEC has said they want to loosen these regulations as well to make it easier to invest in private companies. That looks like it's moving toward tokenization, which means using blockchain technology to allow multiple investors to invest in an underlying asset and doing that on the blockchain. And tokenization will open up a lot of avenues. The SEC is working on this rule, and it could happen next year, and it could happen very quickly. It also would allow the tokenization of publicly traded stocks so that people around the world could invest 24/7 into American companies. There's still a lot of unknowns here, especially if there are a lot of investors who want to own, say, an OpenAI in the private markets, and there's not enough of the underlying asset to go around. It could really inflate prices and cause some imbalances. So tokenization, very interesting concept, and potentially could open up the floodgates for retail investors to invest in private companies. I'm all for that. Just hope there aren't going to be some unintended consequences when that happens. But the deregulation of the pre-IPO investing marketplaces could lead to fewer IPOs. There's also the accreditation standard that really needs to be updated as well. And it looks like the SEC is going to tackle that as well, hopefully next year. So if they change or eliminate the accreditation requirement for retail investors, that would give us a lot more opportunities to invest. Instead of having an income threshold or a net worth threshold, it could mean a quiz or a certification to indicate that you are knowledgeable enough to invest in these companies. It's ridiculous that retail investors can buy meme coins and gamble in a casino, or now gamble on sports or whatever, but they can't invest in Elon's private company or the next great founders building businesses. So that disconnect is hopefully going to be addressed by the SEC, but it may not help with IPOs, but it may help with access. And access either way, either a pre-IPO or in the public markets, will take it. And the last idea that I'll throw out there that would incentivize companies that are private to go public is tax incentives. What if you lower the tax thresholds on newly IPO'd companies? That would possibly encourage companies to leave the private markets and go public. If they could reduce their tax burden for, say, 3 years or 5 years or 10 years. I'm not a big fan of legislating through the tax code. I spent about 20 years consulting for the IRS on their IT, and I see what a mess it is, and what a mess it is when legislators create laws that involve tax changes. It becomes a huge burden on the IRS. So while that could be something that moves the needle, I don't know that I really like that idea, having been so close to the IRS for so many years. But this is all about incentives. And if you want to incentivize private companies to go public, a tax incentive would probably do the job. No matter what your favorite slogan is or your political leanings, I think we can all agree that more streamlined government processes that still protect investors is the way to go. If it needs a slogan like Make IPOs Great Again, then let's go with it. Let's move on to IPO Radar news. Things seem to be slowing a little bit headed into the holiday season. Not seeing as many fundraising news stories out there or companies moving toward an IPO. We did get a few stories this week, and I'm recording this Wednesday a little bit early just based on my schedule, so it's a good chance that some stories are going to come out Thursday and Friday that I would normally have reported on. The big news is that the government shutdown looks like it's coming to an end. I don't know how the voting works or when the actual end is going to come or when the federal workers are going to go back to work. Presumably by the end of this week, things will be cleared for the government workers to go back to work the following week. Of course, we're headed into Thanksgiving and Christmas, and so people won't be working as much anyways. We talked about Medline recently. They were in limbo. They may now be waiting for the government to reopen and try to get their IPO out by the end of the year. There was an article from The Information by Katie Roof that talked a little bit about this, and they were talking to some experts who were saying, hey, we think that companies are just going to wait until Q1 or spring of 2026 by this point. Once the government reopens, we may see some filings get updated, and that could give us some clues if any companies are going to go for it before the end of the year. Hopefully Medline is one of them. BitGo is another one that could go public. Once Upon a Farm, and there's a handful of others. But it looks like most will probably move on to 2026, which means 2026 could be a blockbuster year for IPOs, at least in the first half, as long as the market maintains its momentum or doesn't crash or anything like that. We could see just a massive amount of volume. So putting together my upcoming IPOs list for this year is going to be really challenging because there are just so many that didn't go public that hopefully will be going public, and others that have just been waiting for 2026 to go public. Either way, it's good to see the government opening so we can get that volume out the door and investors can participate in the upcoming IPOs. First company story of the day came out this morning, Wednesday the 12th. Kim Kardashian's Skims is worth an extra $1 billion. The apparel giant is now valued at $5 billion after a new fundraising round as it continues to grow its business. So the New York Times, I'm reading this from a deal book. So Kim Kardashian's apparel giant Skims has raised $225 million in new financing at a $5 billion valuation. It's the latest sign of success for Skims, which has grown significantly beyond its shapewear and underwear roots. The round was led by Goldman Sachs Alternatives with participation from BDT and MSD Partners. The company was founded by Kardashian and Jan's Greed in 2019. It's profitable and expected to have $1 billion in net sales in 2025. Skims has been on my radar for a few years now, and there was a point in time when Jan's Greed was talking about an IPO, and they sort of hinted that they were aiming for an IPO at a $4 billion valuation. And this goes back, I think, to 2023 or so, 2024 maybe. And then shortly after that, he walked back those comments about an IPO saying that, hey, we're pretty happy being private. I have a lot of excitement for this potential IPO of Skims because it's an opportunity for Kim Kardashian to offer IPO shares to her customers. There are several million customers who shop at Skims who would love to be owners of that company or part owners of that company. So we look at directed share programs and opportunities for companies to offer shares to their customers. And it's a mechanism in the S-1 filing that works very well. The issuer partners with someone like Fidelity or Click Markets to deliver shares to customers who want to invest. This year, in 2025, we've seen some record number of shares being allocated to retail investors. That was true with Bullish and Gemini. I think they allocated something like 20 to 30% of shares to retail investors. Why not take a chunk of that, 10%, 20%, and allocate that to your customers who are going to be more likely to invest for the long term? Long-term investors buy more from your company or better customers. Skims, I think, would be the perfect company to do this. Now, I've spoken to an expert or two about this topic specifically, and yes, it makes perfect sense. The only thing that would maybe hold them back from doing this would be the lawyers. The lawyers may say, no, don't do this. You're opening yourself up to liability. If you launched your IPO and it was priced at X, and a month later or a couple years later, the stock falls dramatically, then you could be introducing some risk to your business, lawsuits, class action lawsuits. If the IPO is priced fairly or is priced below fair market value and you allow customers to invest and the stock price jumps afterwards and everyone's happy and the stock price stays above that IPO price, then there's no litigation risk, or at least there's maybe less litigation risk. So the expert I talked to on this topic said, yeah, that'd be great to see them do do it, and they should do it, and I think they want to do it, but it's a matter of, will the lawyers allow it, or will they say, no, don't bother, just go with a traditional IPO, don't offer shares to your employees, and just let them buy it on the open market. So Skims, one of the top companies I would like to see IPO because of this customer relationship that they have. I think it'd be an opportunity for customers to invest in a company they love and hold on it for the long term, which helps to keep that price stable and growing. If you got enough long-term customers to become investors and long-term shareholders, then it would almost put a floor on the price at the IPO price, because they're not going to be flipping shares if they want to own this for the long term, unlike institutional investors or finicky retail investors at Robinhood or SoFi. So Kim, if you're watching the show, please implement a directed share program for your customers to allow them to invest in your IPO. It's going to be a win-win for you and for your customers over the long term, and even other shareholders, because your customers are going to hold shares longer. At a $5 billion valuation and $1 billion in revenue, this company should be ready to IPO, and maybe this round was one of these final rounds before they actually move forward with the IPO. Last story is another consumer-centric company that's not selling underwear, but selling wearables, not a wristwatch, but a wrist device. The company is Whoop. Whoop is the maker of popular screenless fitness bands. An article came out of Bloomberg saying they're eyeing an IPO as soon as the next 2 years and is exploring adding glucose monitoring to its health tracking platform. Potential IPO in 2 years. That's good to hear. They always say within 2 years, and maybe this CEO is saying this in a way that's honest, because once you start thinking about an IPO, it doesn't happen quickly. We've seen this with several IPOs, including Skims. He said, we were thinking about an IPO and then had to pull that back. Within 2 years, I think that's a good chance that we could see this company IPO in 2027, Whoop, possibly 2026 if the IPO markets become euphoric and people are really excited about companies who are IPOing. Whoop founder and chief executive officer Will Ahmed said the business is well positioned for an IPO now that it's broadened its portfolio to include proprietary technology, hardware, software, and analytics, and other items like accessories and apparel. I would think about it over a horizon of 2 years, he said. While Ahmed has previously said Whoop is likely to go public, he hadn't shared when it may happen. Whoop is another one of these companies that could benefit from offering IPO access to its customers. They have a large customer base who are fans of the product. Why not offer IPO access to them so they can become long-term shareholders at the IPO price? This is a no-brainer from my perspective. We've seen this from Uber. Airbnb offered IPO shares to hosts. This has been done before, and it works pretty easily. You just set aside a number of shares. 5% is usually the number, but there's no reason they can't do 10 or 20%. You offer IPO access to your customers. Customers make good long-term shareholders because they're already a fan of the product. Why not give them access to company equity? In terms of consumer products or stores or restaurants, I think this is a no-brainer for companies to consider this. The directed share program, bring in your customers as IPO investors and long-term shareholders. It's going to benefit you, it's going to benefit your customers, and it's even going to benefit other shareholders because your customers will be less likely to flip shares and sell in the short term and more likely to hold over the long term. 2 years away, it's a little disappointing. I'd rather him say within the next year. So it kind of seemed like an off-the-cuff statement. Seems like Bloomberg had direct access to the CEO for this article. He also mentioned blood glucose monitoring. And this one's near and dear to me because I have a family member that uses glucose monitoring devices that are invasive because they have to insert a little cannula under the skin to get blood glucose readings. If you could do this from an Apple Watch or a Whoop watch, wow. That would be a real game changer for people who have trouble managing their blood sugars. We've heard that Apple's been working on this with their watch, and Oura Ring is probably looking into it too. I think it's just very challenging to get a blood glucose reading from an external device. If Whoop or another one of these device makers could find a way to accurately measure blood glucose readings through an external, non-invasive device, it'd be an incredible game changer for the diabetes community and for athletes too. Athletes want to see where their peak performance is. Blood sugar doesn't stay steady whether you have diabetes or not. So that could be huge news alongside a potential IPO. If within 2 years, Whoop is IPOing and managing blood sugars, that'd be a pretty thrilling business that I'd invest in, or at least try one of their devices for my own use. Just checking out Whoop on Caplight before I end the show. Looks like they last raised a Series F in 2021, August of 2021. Remember, that was that euphoric year where a lot of companies were raising at high valuations. It raised at a post-money valuation of $3.6 billion. It raised $200 million, and it hasn't raised funds since then, according to Caplight, which means they're probably profitable. Caplight estimates the valuation only about $1.8 billion at this point. So it's good to see the company talking about an IPO versus an acquisition, because at $2 billion valuation or so, someone could easily scoop this company up. But to see that CEO talking about an IPO is someone who's thinking long term. He's telling his customers that, hey, we're going to maintain control of this business, and we have high hopes, and we have growth ideas for the company, and we want to keep this under our own wings. CEO said in this interview, we like to build things ourselves. We really want to build this home of health for our members. If you ask yourself what public company today owns personal health, what company comes to mind? It feels like a company should be a big company in the world that is known for owning personal health. A potential IPO would cement Whoop's position as a leader in the wearables and wellness space, particularly in the growing subcategory of screenless gadgets offering alternatives to smartwatches. Smartwatches have that distraction factor to them. They're always, giving us messages. So these monitoring devices that don't have screens, some people prefer. So great to see another company entering the pipeline of IPOs that are actually thinking about moving forward. I'll be keeping a closer eye on this one. I'll move it up my list of upcoming IPOs. In mid-2026, maybe we'll start hearing more about this company's plans. That's all for the show this week. Thanks for tuning in. Don't forget to sign up for my Access IPOs newsletter. It comes out weekly on Sunday mornings. That's where I recap the podcast episode if you don't have a chance to listen to the whole thing. There's easy links to listen to the show. And then there's stories that maybe I didn't get to cover on the show at the bottom in the IPO Radar news. I usually offer some commentary on the week and the things that's happened. So don't forget to subscribe to my newsletter. And this month in particular, I'm going to be running a Black Friday deal on our Patreon membership group. The Access Club is a place where like-minded investors can connect and discuss upcoming IPOs or pre-IPO investment opportunities. We chat about upcoming deals, where to find the best access, and members have direct access to me. You can chat with me right there on the platform. This coming Black Friday or the last week of November is when I'll be offering the deal, so keep an eye on the newsletter emails for that deal. It's probably going to last maybe 2 Sundays, 2 newsletters long. So if you're thinking about joining the Access Club today, maybe wait a week or two, join that newsletter, because I'm going to give you a really good deal on membership to help bring you into our community and get ready for the volume of IPOs that we expect to see in 2026. That's all for the show this week. Thanks for listening. Thanks for watching. And I'll see you next week. This video is not a recommendation to buy or sell any startups mentioned. Pre-IPO and IPO investing involves significant risk. Conduct due diligence by reading the SEC S-1 filings before participating in IPOs. Do not invest in IPOs with money you cannot afford to lose. Thanks for watching.